You are constantly told by financial news, that when a country's currency gets cheaper, it's like this massive economic superpower.
Right, the classic export boost.
Exactly. You see these anchors pointing to a chart, and they claim that a weaker currency automatically makes local goods cheaper for the rest of the world to buy.
It's presented as a fundamental rule of macroeconomic physics.
Yeah, but uh, what if that exact same supposed superpower was actually a silent, invisible slaughterhouse, like a mechanism that systematically suffocated thousands of everyday businesses?
Well, that is the illusion we are breaking apart today. I mean, we like to think of macroeconomic forces as this rising tide that lifts all boats.
Sure.
But the reality, especially during a financial shock, is an asymmetrical filter. It protects the giants and completely wipes out the businesses at the bottom.
Welcome to today's deep dive. We are unpacking a classic, frankly groundbreaking investigation published by the National Bureau of Economic Research.
By researchers Yun Jung Kim, Tesar, and Jing Zhang.
Right. And their mission here was to look beneath the hood of the infamous 1997 Korean financial crisis. They wanted to expose a horrifying truth about who actually pays the price when a national economy crashes.
And their findings completely upend how we are taught to look at corporate debt. The value of this specific paper is that they refuse to accept the standard top-level explanations.
They didn't just look at the dashboard.
Exactly.
Yeah.
They dug into the microdata to solve a mystery that traditional macroeconomic models had essentially completely botched.
Because the traditional models were only measuring the survivors.
Yes.
So to understand the sheer scale of the shock they were investigating, we really have to establish what South Korea looked like right before 1997. Because, you don't fully grasp the devastation until you understand the altitude they fell from.
Oh, absolutely. For 20 straight years, South Korea was the textbook example of rapid industrialization.
Miracle on the Han River.
Right. It was an era of seemingly unstoppable high-speed economic growth, and then in the span of just a few weeks, the entire nation hit a brick wall.
The raw destruction here, it's staggering. We aren't talking about a mild recession. Real GDP shrank by 7%.
Which is massive for an entire nation.
And consumption plummeted by 14%. Investment collapsed by a staggering 35%. Total employment dropped 5%.
Yeah, that 35% drop in investment is the number that really jumps out.
I want to pause on that because numbers like that can easily just wash over you when you're listening. Imagine driving down the highway at 100 miles an hour for 20 years straight.
Right.
Factories are expanding, new office buildings are going up, and then someone throws the car into reverse without hitting the brakes.
That's exactly what it felt like. A 35% collapse means construction sites suddenly go quiet mid-build. Corporations just cancel millions of dollars in equipment orders overnight.
The entire capital expenditure pipeline of a nation just freezes.
And the international metrics were just as violent. The country's current account reversed by 15 percentage points almost overnight.
Wait, 15 points?
Yeah, it went from a negative balance of 4% of GDP to a positive 12%.
Okay, we hear the term current account thrown around on TV all the time. For anyone trying to visualize this, think of a country's current account like its checking account with the rest of the world.
That's a good way to put it.
So a negative balance, a deficit, means South Korea was buying more from the world and borrowing foreign capital to fund its rapid growth.
Right, they were importing machinery, raw materials, all that.
So how does a country suddenly swing from -4 to +12 in a matter of months?
It happens through a massive, forced, sudden stop. Foreign investors and banks basically panic and pull their capital out of the country.
So South Korea can't borrow anymore.
Exactly. To pay back the foreign money fleeing the country, they are forced to drastically cut imports and export everything they can just to generate foreign currency.
So that 15-point swing isn't a sign of new prosperity.
No, not at all. It is the financial equivalent of a household selling off its furniture just to meet a sudden margin call from the bank.
Wow. Which brings up the central question here. How does an entire nation build a trap this deadly for itself? Because a 35% collapse in investment doesn't just happen from bad luck.
It doesn't. The crisis was engineered by extreme, unchecked credit inflation. The NBER paper outlines this as the deadly hotbed.
So what was the setup?
Well, between 1995 and 1997, total private credit in South Korea soared from 104% of their GDP to nearly 120%. The entire system was levering up.
So businesses of all sizes are just borrowing heavily to fund that, economic miracle expansion.
They are, but the fatal flaw is where they were borrowing from and the specific terms. Foreign debt hit an astronomical 60% of the nation's GDP in 1997.
Okay, 60% is high.
And here is the most dangerous variable. Over one-third of that external debt was short-term debt.
Meaning it had to be paid back in less than a year.
Yes. Think about the mechanical fragility there. You have an entire economy running on borrowed foreign money, and a massive chunk of it can be demanded back by foreign banks at almost a moment's notice.
It requires constant rolling over. The foreign bank has to agree to renew the loan every few months.
Exactly. It's the perfect recipe for a bank run.
This is such a critical point for you, the listener, to understand when watching the news today. You hear about national debt or total corporate leverage all the time. But this deep dive reveals that the total amount of debt doesn't matter nearly as much as who is holding it, what currency it's in, and when it's due.
Right. $1 billion of 30-year fixed domestic debt is just a manageable mortgage.
But $1 billion of 3-month foreign debt is a balloon payment that can destroy you if the lender gets nervous.
The vulnerability is structural. The bomb was built, armed, and completely reliant on a steady stream of foreign confidence to keep the timer from hitting zero.
So the confidence evaporates in late 1997, the timer hits zero. Let's look at the historical price that everyday businesses actually had to pay.
The trigger was the collapse of the Korean won.
Right, and I want to frame this for you with a basic analogy. If you woke up tomorrow morning and your monthly mortgage payment had miraculously doubled, but your salary had been cut in half, mathematically, how long would your household survive?
Probably not very long.
Exactly. Because that scenario is exactly what happened to thousands of Korean businesses.
In the final weeks of 1997, the currency depreciated by almost 100% against the US dollar.
We have to break down the math of that depreciation because it's the core engine of the destruction.
Let's do it.
If you are a local Korean business owner, say a mid-sized logistics company, and you borrowed in US dollars to buy a fleet of trucks, let's say you borrowed $10,000.
Okay.
At the time you took out the loan, the exchange rate meant that loan was worth about 8 million Korean won. You operate your business locally, your clients pay you in won.
Right. Your income is in local currency.
You have a steady cash flow plan to pay back that 8 million won equivalent. But then the currency depreciates by almost 100% against the dollar.
Suddenly, overnight, you need 16 million won to buy the exact same $10,000 to pay back the foreign bank.
Your principal debt burden just doubled, literally out of thin air. You didn't mismanage your business, your trucks are still running the same routes, but your balance sheet is suddenly completely underwater.
And the macroeconomic defense mechanisms made the situation even worse.
How so?
To try and stop the currency from falling further, the central bank had to intervene, and the primary tool a central bank uses to defend a currency is raising interest rates.
To attract capital back into the country.
Right. So short-term nominal interest rates mutated. They went from a pre-crisis normal of 10 to 15% and skyrocketed to a historical peak of 25.6% by January 1998.
That is a structural wipeout. Your principal dollar loan just doubled, and the interest rate you were paying on any new domestic credit to keep afloat just hit 25%.
The cash flow required to survive that just doesn't exist for a normal company.
But here is where it gets really interesting and honestly a bit infuriating.
Yeah, the academic blind spot.
Right. Despite this total financial bloodbath, traditional international academic studies looked at the aftermath of the Korean crisis and came to a face-slapping conclusion.
They claim that holding foreign debt didn't hurt companies.
Wait, what?
Some of the most prominent studies at the time actually concluded that the damage from the currency depreciation inflating debt was negligible. Some even argued it helped them perform better.
How on earth can you look at a country whose currency is in free fall and conclude that owing money in foreign dollars is totally fine? It defies basic arithmetic.
It makes no sense until you look at how academic research often operates. The NBER paper highlights that previous studies only relied on the data that was easily accessible.
Which is a classic case of survivorship bias.
Exactly. Traditional models were relying almost exclusively on databases like WorldScope, which only track large, publicly traded corporate giants.
So they were only studying the shiny survivors.
Yes, they completely ignored the graveyard of unlisted, private, and newly bankrupt companies that died.
You know, this sounds exactly like the famous story of Abraham Wald and the World War II bombers.
Oh, the bullet hole story.
Yes. The military was looking at the planes returning from missions covered in bullet holes, mostly on the wings and the tail. So the generals concluded They needed to put more armor on the wings and the tail.
Because that's where the damage was.
Right, based on the data they could see. But Wald pointed out the fatal flaw. They were only looking at the planes that survived the trip back. The planes that got shot in the engine were sitting at the bottom of the ocean.
The bullet holes on the surviving planes actually showed where a plane could be hit and still survive.
That perfectly describes the academic blind spot here. These macroeconomists were looking at the surviving corporate giants, seeing they held a lot of foreign debt and concluding, oh, foreign debt must not be dangerous.
They were writing economic policy based on the bullet holes of the survivors.
So how did Kim, Tesar, and Zhang actually fix this? How do you measure the planes at the bottom of the ocean?
They executed what we can call the Michigan breakthrough. They realized the standard databases were fundamentally flawed. So they went to the Korea Information Service and merged a massive, incredibly detailed database of over 4,000 firms.
They didn't just pull the top 50 conglomerate.
No, they pulled everything.
Yeah.
Unlisted companies, privately held regional businesses, and crucially, they retained the historical data of the bankrupt businesses.
They dragged the sunken planes into the laboratory.
Exactly. They put the unlisted, the private, and the newly bankrupt businesses under a microscope.
This is something you've probably experienced in your own life. When people only study the winners to write a success manual, they miss the fatal mistakes that killed everyone else.
It's so true.
If a billionaire writes a book about taking massive, unhedged risks, it sounds like brilliant advice. But they are completely blind to the 10,000 people who took the exact same risk and lost everything.
And once these researchers applied their full-spectrum database, the entire narrative inverted. They found a massive, uncrossable chasm between the giants and the average business.
Let's talk about that chasm. Because if this toxic foreign debt is a universal poison, why didn't the massive conglomerates die from it too?
The structural differences are stark. Let's look at the publicly listed companies, the giants. On average, they were significantly older, about 22 years in operation, and a staggering 64% of them held foreign debt.
Compared to what in the broader market?
In the full sample of 4,000 firms, only 39% held foreign debt.
So the biggest players were the ones gorging on foreign dollars the most.
Heavily exposed. Furthermore, 27% of those listed firms exported goods, compared to only 16% of the broader market.
Which leads to what the researchers call the giant's paradox.
Right. During the crisis, the large listed companies with massive foreign debt exposure actually saw smaller sales declines, and they were less likely to go bankrupt.
Okay, I have to jump in with a reality check here. So what does this all mean? The big guys gorge on debt and get stronger, while the little guys take a tiny sip and die. That sounds like the game is rigged.
It is rigged. But it's not that foreign debt is magically safe for giants. It's an omitted variable reality.
Meaning there's something else protecting them that isn't on the standard spreadsheet.
Exactly. Giants had access to financial derivatives to hedge their bets.
Complex insurance contracts.
Right, like currency forwards or swaps. If a giant knows they owe US dollars in 6 months, they buy a derivative contract that guarantees they can buy those dollars at today's cheap exchange rate.
So when the one collapsed by 100%, the giant corporation didn't care. The derivative payout completely buffered the blow.
Yes, and small businesses simply don't have the cash or the banking relationships to buy those complex tools.
They're locked out.
Completely. And derivatives are only half of the privilege. The other half is backroom access to emergency credit. Many of these giants belong to chaebols.
The massive family-run conglomerates in Korea, like Samsung or Hyundai.
Right. When the financial system freezes, the local hardware manufacturer gets his credit line cut instantly. The bank pulls the plug.
But the chaebol gets emergency cash because they are deemed too big to fail.
Exactly. They had an umbrella, the small businesses. They were forced to endure a Category 5 hurricane completely naked.
Wow. When you read about corporate bailouts or debt restructuring today, you have to realize that the rules of gravity simply do not apply to the top 1% of firms in the same way.
They live in a different physical universe of risk.
But wait, didn't we say at the beginning that a cheap currency helps exports?
We did?
Why didn't these small businesses just export their way out of trouble? If their goods suddenly became 50% cheaper for foreign buyers, shouldn't they have seen a boom in orders?
That is the terrifying truth hidden in this microdata. They call it fatal nakedness.
Fatal nakedness. What does that mean in the data?
It means 70% of all Korean firms holding foreign debt did not export a single thing.
Wait, really? 70% had zero export revenue.
Not one. They were entirely domestic-facing businesses. They couldn't reap the rewards of a cheaper currency.
So a local grocery chain or a regional developer, they borrow in dollars, but their customers only pay them in local won.
Exactly. And for the smallest 25% of firms, this was absolutely disastrous. 90% of them held foreign debt without any export revenue.
90%. They were completely unhedged.
Barely any protection at all.
Why would you stand in the rain with no umbrella? Why borrow in dollars if you only make one?
Because before 1997, the Korean won was heavily managed against the US dollar. It barely moved. And domestic Korean interest rates were high, around 12%, while US dollar rates were maybe 7%.
So the local business owner looks at the options and says, why pay 12% when I can borrow in dollars at 7%? The exchange rate never changes anyway.
It looked like free money until the peg breaks.
Okay, let's unpack this.
What?
You are betting your entire company's life on the exchange rate staying flat forever. You are stepping in front of a steamroller to pick up pennies on the interest rate spread.
It's a catastrophic miscalculation, and the consequences are visible in what the paper calls the vanishing souls.
The liquidation rate.
Right. The corporate liquidation rate doubled from a pre-crisis 2% to 4.8%.
And the victims.
Young, small, highly leveraged, low-profit firms, the unhedged domestic businesses.
And the publicly lifted giants.
They had exactly zero liquidations during the crisis in this sample.
Zero. In the middle of an economic apocalypse.
Yes. The safety net for the giants was absolute. And the paper actually breaks down this death sentence mathematically.
How microscopic of a difference are we talking about?
For the smallest 10% of firms, adding just one single percentage point to their foreign debt ratio directly boosted their bankruptcy risk by 0.28%.
So every tiny drop of dollar debt pushes the little guys closer to death.
But for the top 10% giants, adding 1% of debt actually lowered their bankruptcy risk by 0.23%.
That is insane.
Yeah.
Debt is literally a poison for the poor and a protective medicine for the rich.
It's bizarre world arithmetic.
Think about your own company's strategy right now. Are you taking on liabilities in one currency, like variable interest rates, while your income is fixed in another?
It's a game of financial Russian roulette where only the small players have bullets in the chamber.
And the researchers actually found a mathematical line in the sand, right? A literal threshold between life and death.
They did. They found the exact percentage point where the Grim Reaper stops knocking.
Exactly. How big do you have to be to survive?
The dangerous inflection point is the 54th percentile of asset size.
So just barely above the median size.
Right. If you were below the 54th percentile, any increase in foreign debt drastically pushed you toward bankruptcy. The bottom 10% of firms had a 7.3% predicted death rate.
And above that line.
The top 90% only had a 4.7% death rate, and taking on more debt didn't push them over the edge.
It's like building a house on a hill in a flood zone. If you're on the 53rd step, you drown completely. If you're on the 55th step, your carpets don't even get damp.
Exactly. And this leads to what academics call the extensive margin, or what we can call the invisible graveyard.
This part is crucial because it shows how macro data can basically gaslight the public.
Right. When macroeconomists look at a crisis, they traditionally measure the total drop in sales. They look at the surviving companies and measure how much they shrank.
The intensive margin.
Yes. But they completely ignore the firms that were wiped off the map entirely, the ones that went to zero.
The extensive margin.
Right. During the crisis, the total vanishing of bankrupt firms accounted for a massive 20% of the entire macroeconomic sales contraction.
20%.
Yes. Historically, firm deaths only accounted for about 3% of sales drops. In 1998, it jumped to over 10% of the total plunge.
Let me translate this with a medical analogy.
Yeah.
Because if you only measure the survivors, you are completely blind to a fifth of the actual economic devastation.
Go for it.
Imagine a hospital trying to figure out how deadly a new disease is. The traditional economists are walking into the recovery wards, weighing the surviving patients and saying, wow, everyone lost 10 pounds. This disease causes moderate weight loss.
While completely ignoring the morgue in the basement.
Exactly. If instead of measuring the dead, you only measure the weight loss of the living, you drastically underestimate the true lethality of the disease.
By ignoring the dead, traditional economics completely fail to see the real damage to local communities and employment.
So when you hear politicians cheering that the stock market is recovering, remember this invisible graveyard. The stock market only tracks the giants who survive.
It doesn't track the neighborhood businesses that vanished entirely.
To prove just how warped this reality is, the researchers ran a mind-bending time travel experiment.
The counterfactual simulation.
Right. Set this up for us because the answer is completely maddening.
They took their model and asked, what if, right before the crash, we forced every single company in the economy to take on 10% more short-term toxic debt?
Logically, you'd think injecting more toxic debt right before a currency collapse would utterly destroy the national economy.
For the smallest firms, it was accelerated destruction. Their simulated sales growth crashed further, from negative 2.9% to negative 4.5%.
And their bankruptcy probability?
Violently doubled. From 7.2% to 14.6%, it was absolute poison.
But what about the massive giants?
Their sales growth miraculously improved. It went from negative 13.5% to negative 9%.
Wait, why would more debt help the giants in the simulation?
Because the model recognizes the structural privilege. It knows that when a giant takes on debt, they usually deploy it alongside those systemic protections derivatives, chaebol credit.
Oh, wow. Okay, so you double the bankruptcy risk for the little guys, wipe out a huge chunk of the working class. What happens to the overall national data?
This is the macro lie. Because the massive giants mathematically dominate the national data, the overall Korean national sales growth actually improved in this simulation.
At what UP?
Yes, from negative 12.6% to negative 8.6%.
That is a terrifying lie. Because the mega corporations made a few extra billion, the national GDP looks better, while the micro-level reality is a complete tragedy.
This is the danger of relying on macro averages. Averages lie when inequality is this steep.
Assessing an economy's risk isn't about looking at the total volume of debt.
It is entirely about the microstructure of who holds that debt.
You see this today when inflation hits. The news will say average wage growth matches inflation. But that average hides the fact that billionaires are making a fortune while everyday people can't afford groceries.
The mathematical average tells you absolutely nothing about the distribution of the pain.
Which brings us to the final piece of the puzzle. We know the giants survived because they had an umbrella. Exports, derivatives, credit.
Right.
What happens if we run the simulation again, but this time we rip the umbrella out of their hands?
The researchers ran a second simulation where they stripped away all export revenue. They removed the natural hedge of a depreciated currency.
So nobody gets the export boost.
Exactly, and the result was catastrophic. Without the export shield, the total national sales growth cratered from negative 12.6% down to negative 14.6%.
Who took the biggest hit?
The giants did. They suffered the most brutal, cliff-like drop because they were the most dependent on exports to cover their massive foreign debts.
So a financial crisis is basically a giant corporate vacuum cleaner.
That's the operating logic of the world.
The big guys hedge their bets, survive the crash because of their umbrella, and then buy up all their dead smaller competitors for pennies on the dollar.
Every global financial tsunami ultimately results in a massive wealth transfer from the bottom to the top. Large capital thrives in volatility because it has tools. Small capital is naked.
The SMEs are the ones left holding the check for the crisis.
Always.
So the mystery of the 1997 Korean crisis is solved.
Oh.
But looking around at the world today, are we actively walking blindfolded into the exact same trap?
The NBER study cemented 3 unbreakable laws. 1. Don't trust macro-level debt averages. Look at the microstructure.
2. Small businesses bear the fatal brunt of currency shocks.
And 3, without a hedge, foreign debt is a ticking time bomb.
Right now, global supply chains are fracturing. Interest rates have spiked globally, and massive amounts of corporate debt are coming due.
We are in an era of violent currency fluctuations.
So the provocative question for you to mull over is this. In our current high-interest, deglobalizing world, how many local, everyday companies are currently sitting on unhedged, naked risk?
When the next currency shock hits, will the headline celebrate a mild macro recession while secretly burying another generation of small businesses?
The data says history doesn't just rhyme, it repeats. Thank you for joining us on this deep dive.